What is driving the current commercial real estate crisis, and where do the opportunities lie? With interest rates having surged from near zero to over 5% since 2021, the commercial property market is feeling unprecedented pressure, causing valuation declines of 20 to 30% across various sectors. Let's delve into this complex situation and uncover where savvy investors might find opportunities amidst the chaos. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Since 2021, interest rates have risen dramatically, impacting commercial real estate values significantly. The market has seen declines of 20 to 30% across various sectors, with commercial properties fundamentally operating as business operations, where property values are directly tied to interest rates, revenues, and operating expenses. This rise in interest rates has created a refinancing time bomb, as most commercial properties operate on adjustable rate mortgages with relatively short terms of 3 to 7 years. This means many property owners now face the daunting challenge of refinancing at substantially higher rates, often requiring significant additional capital injections. The pandemic has also played a significant role in transforming workplace dynamics, with office occupancy rates remaining 30 to 40% below pre-pandemic levels in major markets across the country. This shift has led companies to strategically reduce their office footprints by 20 to 50% through lease cancellations and downsizing, creating unprecedented vacancy levels, particularly in older, less amenitized buildings. Class B and C office buildings face vacancy rates exceeding 25% in many urban centers, with some markets experiencing even more severe conditions. The banking sector is also at risk, with nearly $3 trillion in outstanding commercial real estate loans in the United States market, and approximately $1 trillion requiring refinancing within the next 24 months. Regional and community banks hold roughly 70% of commercial real estate debt, creating concentrated risk in institutions that may be less equipped to absorb substantial losses. Delinquency rates have doubled since 2022, particularly in office and retail sectors, signaling deepening distress. Despite these challenges, there are opportunities for investors. Distressed asset sales have increased 300% year over year, with special situations in bankruptcy and foreclosure proceedings becoming more common. These forced sales establish new, lower price points that ripple through the market. Additionally, industrial properties remain the bright spot, with minimal valuation declines and decreasing vacancy rates, as e-commerce and logistics demand continue to grow. In contrast, multifamily housing in high-demand markets shows resilience with moderate valuation declines, supported by the ongoing housing affordability crisis. With approximately $500 billion in commercial loans maturing in 2025 alone, the refinancing challenge is unprecedented, and interest rate cuts could be critical for commercial real estate recovery. A 1% decrease in interest rates can increase property values by 10 to 15%, potentially creating sufficient value to bridge refinancing gaps. The Federal Reserve's recent rate cuts partially address this systemic concern, opening a window for refinancing that could prevent widespread defaults. The mathematical relationship between rates and values creates a powerful tool for market stabilization. Lower rates allow property owners to refinance without substantial additional equity contributions, preventing widespread defaults and market disruption. Asia-Pacific commercial real estate investment has surged to $31.2 billion United States dollars in the second quarter of 2025, marking a 15% year-over-year increase, as reported by the global real estate consulting firm JLL. In the first half of 2025, investment volumes totaled $67.6 billion United States dollars, up 17% compared to the same period last year. Despite cautious sentiment and extended due diligence due to ongoing economic uncertainty, the region continues to attract significant global capital. South Korea experienced the highest year-on-year growth in the Asia-Pacific region, with a 72% increase in the second quarter, totaling $6 billion United States dollars. This growth was primarily driven by the office sector, which accounted for 77% of total market volumes, as sellers sought to divest before oversupply materializes in central business districts. Additionally, several hotels changed hands as sellers capitalized on improved operating performance to secure premium pricing. Japan maintained its position as the strongest performing market in the region, posting 7.6 billion United States dollars in commercial real estate investments in the second quarter of 2025, a 31% year-over-year increase. The office sector dominated, with domestic investors being the most active. The living sector volumes reached their highest quarterly level since the first quarter of 2022, with strong interest from J-REITs and foreign buyers, including Warburg Pincus, Aberdeen, and Capitaland in multifamily assets. According to a JLL survey of 75 Asia-Pacific-based investors, the industrial and logistics, energy and infrastructure, and retail sectors face the most geopolitical risk in the next 5 years, due to trickle-down effects on growth and policy rates. Conversely, the living, life sciences, and healthcare sectors are seen as the most insulated due to their domestic market-driven nature. Stuart Crow, CEO of Asia-Pacific Capital Markets at JLL, emphasized the region's fundamental strength and resilience, citing strong office transactions in Seoul and favorable financing environments as key drivers. In the office sector, investment activity led the second quarter, accounting for 13.3 billion United States dollars in transactions, a 24% increase year-over-year. South Korea saw its highest quarterly office volumes since the second quarter of 2021, while Japan remained active with strong domestic participation. Industrial and logistics volumes reached 6.3 billion United States dollars, rising 12% year-over-year, and retail transactions totaled 5 billion United States dollars, up 4% year-over-year. Investments in the living sector continued to show positive momentum, reaching 3.6 billion United States dollars in the second quarter, a substantial 92% increase compared to the same period last year. Japan remained the dominant market, contributing more than half of the region's total living sector volume. Private wealth investment volumes for the second quarter of 2025 surged by 32% year-over-year to 4.7 billion United States dollars, with offices remaining the most favored asset class for private wealth investors. Pamela Ambler, head of investor intelligence for Asia Pacific at JLL, noted that central banks across the region continue their rate-cutting cycles, resulting in a declining cost of debt and creating a more favorable environment for transactions. This environment should further stimulate investment activity, although investors are now underwriting slower growth scenarios with the assumption that tariffs will remain in place, leading to extended timelines and essential contingency provisions in deals. Markets such as South Korea and Japan continue to demonstrate resilience, offering opportunities for investors seeking long-term growth amidst turbulence. Louisville's retail market is experiencing notable strength in 2025, driven primarily by grocery anchors. Despite national challenges like moderating rent growth and increased construction costs, the metro area has shown resilience, with a vacancy rate of just 3.5%, outperforming the national average of 4.8%, according to CoStar Group. The asking rents have averaged $17.42 per square foot, indicating consistent demand across the region. Grocery chains such as Kroger, Publix, and BJ's Wholesale Club are at the forefront of this activity, each reshaping Louisville's retail landscape in unique ways. Kroger is expanding its presence with several new stores, including a substantial 123,000 square foot location under construction on Beulah Church Road, set to open in 2026. Publix has been aggressively expanding after opening its first store, securing significant square footage at Blankenbaker Plaza and Prospect Point. Meanwhile, BJ's Wholesale Club has taken a redevelopment approach, transforming the former Sears building at Jefferson Mall into a 104,000 square foot store that opened earlier this year. These projects highlight the appeal of essential, needs-based retail, while also driving complementary leasing activity in nearby trade areas. The momentum from grocery anchors is also spreading to other retail categories. Quick service retailers and experiential concepts are filling market gaps, with fitness centers like TrueFit Athletic Clubs and Nova Trampoline Park opening large format spaces. Smaller operators such as Starbucks Coffee, Dave's Hot Chicken, and other fast casual brands are targeting out parcels and end caps near grocery-anchored centers. The market has also seen significant growth in drive-through beverage concepts, with 7 Brew Coffee emerging as a prominent operator, opening multiple stores in a short span. Dutch Bros Coffee has also entered the market with a new store on Taylorsville Road, contributing to daily use vibrancy and increasing traffic in grocery-anchored corridors. Convenience stores are gaining traction, with Wawa making a highly anticipated entry into the Louisville market. Wawa plans to open 40 locations across Kentucky and southern Indiana, with each representing a significant investment. Quick Trip and Racetrack are also expanding, reinforcing Louisville's role as a hub for daily use, convenience-driven retail. This wave of investment mirrors the success of grocers, bringing essential goods and services closer to consumers and reshaping high-traffic corridors. Although new development has slowed, with only 74,000 square feet delivered in the past year, roughly 40% below the historical average, the pipeline remains strong. Over 322,000 square feet is currently under construction, already 97% pre-leased and dominated by grocery-anchored projects. This indicates that even with higher construction costs, national retailers continue to pursue Louisville aggressively when anchored by necessity-driven tenants. Investment activity reflects these trends, with 275 properties trading for $297 million in the past 12 months. Grocery-anchored centers are commanding premium pricing, as demonstrated by the $20.3 million sale of Publix at Terra Crossing and Saraga International Grocers' $21.5 million acquisition of Forum Center. Looking forward, Louisville's retail story is likely to remain defined by its anchors, with grocery giants like Kroger, Publix, and BJ's setting the pace, while quick-service retailers and convenience stores add vibrancy to the market. These dynamics ensure that Louisville remains one of the Southeast's most compelling retail markets heading into 2026. Lismore Real Estate Advisors has unveiled the latest statistics for the Scottish investment market for the third quarter of 2025, showcasing promising signs of rejuvenation in the office sector. The total transaction volumes reached £440 million across 34 deals, marking a 3% increase compared to the third quarter of 2024 and surpassing the 5-year average by 12%. The office sector spearheaded the market activity, achieving £142 million in transactions, the largest sector total in the third quarter and its most robust performance since the third quarter of 2024. Noteworthy office transactions included the £53.85 million acquisition of Quarter Mile 1 in Edinburgh by Beaumont Real Estate and KZN Real Estate from Epic UK, and the Strathclyde Pension Fund's £19.6 million purchase of Sentinel in Glasgow from Ardstone Capital. In addition to the office sector, the largest deal of the quarter was the £58.5 million acquisition of Martha Street Apartments, a city center purpose-built student accommodation asset by United States investor Harbert Management Corporation from Chris Stewart Group. Another significant transaction was Northwood Urban Logistics' £26 million acquisition of the Malt portfolio from Cedarwood Asset Management, consisting of 300,000 square feet of multi-let industrial trade properties across 6 multi-let industrial estates throughout central Scotland. Chris Thornton, a senior associate at Lismore, commented on the market dynamics, stating, "While transaction volumes remain subdued, we are witnessing distinct signs of renewed activity, particularly from core buyers seeking stable income from strong tenants and platform builders, consolidating retail parks and industrial assets." He further added, "The deepest demand continues to be for sub-£10 million transactions, where asset management potential or short to medium-term reversion opportunities attract private investors, family offices, and property companies. Investor appetite is being driven both by those targeting double-digit yields secured against strong covenants and by value-add players pursuing refurbishment opportunities. French SCPIs remain active, but pension funds, investment managers, and property companies have also re-entered the market, broadening the buyer pool. Macroeconomic challenges remain, but investors are treating them as background noise. After an extended period of caution, the market is beginning to re-engage. The office sector's performance this quarter is a clear signal of renewed appetite, and we expect to see further momentum as pricing and fundamentals align. Toys R Us is making a comeback with plans to open new stores in outlet centers, airports, and Navy bases. Why the shift in location strategy? Well, over 90% of the former Toys R Us sites have been re-tenanted or repurposed, paving the way for a new approach to real estate. Let's dive into how this transformation is taking place. Toys R Us announced it will add 10 new flagship stores and 20 seasonal shops later this year. However, these new sites will not resemble the 700-plus big box retail stores that Toys R Us operated before its 2017 bankruptcy. Instead, most of the new flagship stores are being located in malls and outlet centers. The company has already established a presence at the Dallas-Fort Worth Airport, opened stores at Navy bases, and operates shop-in-shops inside select Macy's stores. The reason for this strategic pivot? Most of the previous Toys R Us locations have been re-tenanted or repurposed. More than 90% of the 700-plus stores have found new life. Burlington, Ollie's Bargain Outlet, TJ Maxx, and Hobby Lobby now occupy more than two-thirds of these re-tenanted former Toys R Us stores. Meanwhile, another 100 ex-Toys R Us sites have been repurposed for non-retail uses such as churches, collision repair shops, U-Haul storage facilities, and even Tesla dealerships. Some interesting transformations include the Center Branch Church in Bridgeport, West Virginia, which acquired a 47,000 square foot former toy store building and transformed it into a new church campus. Similarly, Hertrich Collision Center in Salisbury, Maryland converted a former Toys R Us into a collision center, and U-Haul of Annapolis, Maryland repurposed a former Toys R Us store into a self-storage facility. Another notable example is the Penn State Health Lancaster Pediatric Center in Lancaster, Pennsylvania, which repurposed a former Toys R Us into a medical facility offering various specialties and walk-in care for children. Tesla also opened a vehicle service center in a former Toys R Us location in Akron, Ohio, and the U.S. Department of Veterans Affairs transformed a former toy store in Des Moines, Iowa, into a primary care clinic. The demand for former Toys R Us real estate was driven by their excellent locations in dense, high-traffic corridors, making them attractive for a variety of new uses. Their freestanding nature and adaptive reuse potential allowed for creative transformations into non-retail spaces. As the retail landscape continues to evolve, the rapid re-tenanting and reuse of these properties highlight the potential for adaptive reuse in commercial real estate. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.